I'm Tom Strasberg. I have a career that has involved adult education, and I learned a few things or during the course of that. Some of them the hard way, some of them early on. And so I just want to mention to you that I welcome comments and questions as we go through. I learned that oftentimes there is someone in the audience who knows more about some aspect of a subject than the speaker. And so initially I was embarrassed by that. Now I just say, well, that's a great resource for others who are on the conference. So please jump in if you have questions or comments. I'm going to keep this very well, initially very basic, and I'm sorry for those of you who are really familiar with some of the details of the program, but I want to make sure everybody understands, how it's valuable and why it's valuable. So I'll do that. Another thing I want to say up front is I cannot and I'm not giving tax advice or investment advice or legal advice of any kind. I'm just going to kind of share with you my experience with it. I am on the board of directors of the McMahon Prater Scholarship Foundation that administers this program for the diocese, and so I have a little bit of knowledge. In fact, I should mention up front that there has been concern, and you may be aware of the concern of a bill to repeal the tax credits. We think that it didn't go anywhere during the last legislative session, and we don't think it's going to go anywhere. It hasn't even been reintroduced. It's there, but it hasn't really been pursued, and we don't think it's going to be pursued in this session. So it's not something to be overly concerned about, but at the same time, there are other reasons why this year is an exceptionally good year to take advantage of the tax credit program. It started, I don't know, what it was about 7 or 8 years ago, and the idea was to provide an incentive for people to make contributions to private educational institutions. And in the long run, it actually saves the government, the state of Virginia, some money. It's a state program. It has nothing directly to do with the federal government, although we're going to get into the federal tax implications of it. But it's there to help those who might otherwise not be able to attend private schools to have that option. And so that's basically what it's about. And talk a little bit about how it works. As I said, we'll get into some things that I don't want to get it too complicated. It's not that complicated, but and again, I said I'm not going to give investment advice. Although, in fact, my wife says, if, she gives the best investment advice. She said, if Tom's buying, sell, and if Tom's selling, buy. And that. And that was one of the things I got into. We'll get into an example a little bit later. And I had a little discussion, and I differed with the CPAs who had put that together because I thought that the capital gain was that they used the capital gain was. I said, I think that's unrealistic. I realized that's just my bias because I'm such an incompetent investor. But they said no. They have a lot of clients who have very, very substantial long-term capital gains. And I'm getting ahead of myself. We'll get to that a little bit later. So the point is that individuals and businesses can both benefit from this. If you have a business, there's no practical limit to no upper limit to the contribution that you can make and to the tax credits that you can receive for your business. And businesses can deduct those against a variety of business taxes as well as the income tax. But I'm going to focus primarily on individuals. And if anybody wants to get beyond that or go more into businesses, well, we'll be happy to talk about that. But as far as the individual is concerned, minimum contribution is $500. And the tax credit in Virginia is 65% of that. So my math isn't very good, although I've been told that if I put a dollar sign in front of the numbers, my math skills get better. So that, we'll see about that. But if you And again, it's a credit. And I think probably the most important thing to understand initially is the difference between a tax deduction and a tax credit. In Virginia, the marginal tax, the upper tax rate, and it's everybody practically pays that eventually. It's graduated, but you get to a 5.75% Virginia income tax rate very quickly. And if you have $1,000 tax deduction, how much is that worth in Virginia taxes? At 5.75%. Anybody? Do the math.
$57.
$57. That's right. Well, I suppose if you round up, it's $58. This is $57.50. But if you have a tax credit, a Virginia tax credit of $1,000 as opposed to a deduction of $1,000, how much is that worth on your Virginia taxes?
$650.
It's $1,000. It pays your Virginia taxes. That's the whole difference. And that's the whole idea. How much of your Virginia taxes can be offset by Virginia tax credits? My wife and I, again, just to tell you some of my experience with this program, my wife and I have not paid Virginia taxes for years because it doesn't take that large a contribution, depending upon your income, to offset the entire Virginia tax bill. And I'll get to that a little bit later as to what the additional advantage of that may be. So one other thing, so all right, how do you gauge what kind of contribution you might be wanting to make? Important to know that these tax credits can be carried over for up to 5 years. So let's assume that in 2020, you make a contribution that offsets your Virginia taxes, but it goes farther. I mean, it's much larger than that. And again, I'll get to the end of this. I'll talk to 2020 and why that's a good idea, or it might be a good idea depending upon your circumstances. But the carryover is there for you to use in future years to offset your Virginia taxes. Any questions so far? Okay. Then I'm going to see if I can get the technology to work here and I'll share that. I think Colleen sent you all these materials, but I'm going to take you through, kind of walk you through this example and actually show you what the tax savings are. So bear with me here while I try and get my screen up for you. Oh, one thing you may want to do before I do this, there are there should be, if you move your mouse or your whatever pointing device you're using, at the lower right-hand corner of your screen, you'll see 3 dots. And if you click on that, one of the options that will come up toward the top of the little pop-up window is full screen. And you'll probably want to be in full screen mode in order to see this clearly. So I recommend that you do that. And as you're doing that, if you haven't already, I will get started on this, sharing my window here. Okay, can everybody see that all right? That's the example. That's one of the examples that they use in the brochure. Is that fairly clear on your screen? Okay, well, I'll just kind of talk you through that because it's picture's worth 1,000 words, especially a picture with numbers and dollar signs. But this anticipates a married couple with $165,000 taxable income in a given year. And so that puts them in the 24% tax bracket. So if they make a donation of $10,000 through the tax credit program, as opposed to just making an ordinary charitable contribution of $10,000, they will get in Virginia tax credits, that is credits, $6,500 in credits, not deductions, in credits to offset their Virginia taxes. So if their Virginia taxes are $5,000, well, then they've got $1,500 to carry over to the next year. If they're more than that, well, then they haven't quite fully offset their Virginia taxes. But it is a dollar for dollar offset against your Virginia tax bill. And it's just, to me, that's just absolutely amazing. And then we add to that, there's, of course, a federal tax savings of the charitable contribution. But the IRS ruled, and this is another thing I got to bring up here. A couple of years ago, they said, well, if you receive a benefit from the contribution, and that's been the rule all along, that just they'd never been applied this way before. If you receive a benefit from your charitable contribution, you cannot deduct the contribution to the extent of that benefit. And so then they said, well, a state tax credit is a benefit. So when you deduct it on your federal return, you can only deduct, if it's a $10,000 contribution, the $3,500 is deductible because $6,500 is the federal, is the state tax credit benefit that you receive. So that amounts to another $840. But then, because the Virginia tax system is keyed to the federal tax system, your Virginia tax, you still get a 5.75% deduction benefit from that $10,000 contribution. So you've got a total tax saving of $7,000 plus. Let me just say, I want to say one thing because I don't want to forget to say it. At one point, a couple of years ago, we thought that qualified charitable distributions from IRAs for those who are over the age of 70 and a half would be really a tremendous bonus working with this program. Well, they don't, as the IRS has made this ruling, because that means that the deduction is not fully deductible because you're getting the $6,500 Virginia tax credit. It doesn't qualify as a qualified charitable distribution from an IRA. So you don't want to try and think about using IRAs, this qualified charitable, QCDs, qualified charitable distributions from IRAs with the tax credit program any longer. Now that I've said that, what are some other possibilities? Well, let's say any questions. So you've got it. So for 10,000, you're going to get this money, and it's all real money. It's going to come back to you in credits or deductions. So about something less than $2,500 is what it actually costs you to make a $10,000 cash contribution. So you can provide a huge benefit to our Charlottesville Catholic School students by it costing you, again, if you're depending upon this all depends upon your tax bracket, depends on a lot of things, but this is not an unrealistic example, I don't think. So, but again, and I say this, and I should have said it before, and I will repeat it, I'm sure again, I hope you've got to consult with a tax professional if you use one, or you have to make sure that you understand all the implications of what you're doing. But this is, again, the numbers are pretty straightforward. So for here in this case, something about a quarter of the cost, a quarter of the donation is all it really costs you to make this sort of contribution. Any questions or comments at this point before we move on to something more complicated?
One quick one, Tom. Does it need to be a cash contribution, or can it be stock?
That's about what I'm going to move on to. However, well, let's move on to the stocks, but please don't let me forget to talk about the CARES Act and the implications of that, because the CARES Act provides an additional benefit, but that must be a cash contribution if you're going to take advantage of the CARES Act benefit. The cash, and when I say cash, check, credit card, but not securities. So now, it gets exciting here. Yeah, let's look at the appreciated securities, okay? Here's the same example, Zach and Jennifer, 160 plus thousand taxable income. Everybody see that all right on the screen? Have I got that on there? Okay. So in addition to what we just had, assuming, and this is where I argued with the CPAs, but they said, no, we've got clients, unlike you, who are more astute investors, and it's not unusual for them to have a long-term capital gain that is, they have a cost basis in the stock, that is what they paid for it, or otherwise acquired that basis of $1,000, and now the value of the stock is worth $10,000. So if they sold it, and again, remember that the only time this works is if you've held the security for longer than 1 year. So your short-term gains, that doesn't do any good. But if you have a long-term capital gain, and instead of paying tax on it, you donate the securities directly to the charity, then you, of course, in addition to all those other benefits, you also save the capital gains tax that you would have paid. So, and again, that depends upon the capital gains bracket in which you reside. And again, we're looking here at a married couple, and they're bound to be, under their circumstances, with the amount of taxable income they have and what the kind of adjusted gross income that they must have to get there. I'm saying they're in the 15% tax capital gains tax bracket, even though they're in the, let's say, the 24% ordinary income tax bracket. So then you just add up those numbers and you say, okay, so they're going to save $1,350 in federal capital gains. And there's no capital gains break in Virginia, so it's 5.75% of that $9,000 gain. So they're going to save another $518 on their Virginia taxes. So we add that to the tax saving donation that we used in the donation that we used in the previous example, and we end up with a total tax saving of over $9,000. So that under these circumstances, contributing appreciated securities, a $10,000 appreciated stock donation costs $591. So, and there are ways that, depending upon your tax situation and your tax brackets, there are ways when it can effectively cost you nothing. And it depends, but again, you got to talk to your tax advisors about that sort of thing.
Tom, Sharon has a question.
Sure, please.
It wasn't on this directly. I actually just wanted to understand, when the donation is given, it doesn't then go directly back to, say, Charlottesville Catholic School, right? It goes to the whole diocese and parcel from there. Is that correct?
No, I'll speak to that, and Colleen can explain it further if she'd like. Can we finish with these examples so I can see everybody better? My problem is I can't see everyone when I got this thing up here. So let me just stop sharing this for now. There, that's better. Okay. All right. In the letter of intent to make the contribution, you can designate the school that you want to benefit from it. In this case, the form has already got Charlottesville Catholic School already filled in for you. So the only thing is, in the event that the school could not use all the tax credits that they receive, then and only under those circumstances would those credits be available for other diocesan Catholic schools. Colleen, Mike, you want to add to that? My impression is CCS can use all the tax credits they can get right now. So I don't think we've ever had a situation where someone has designated Charlottesville Catholic School and the money has gone someplace else. Mike?
No, Tom, that's correct. We've not fulfilled the need completely yet over the years we've been doing the program. We've been close. What we try to do is manage those donations and the timing of those donations. I don't know if, Tom, you're going to get to this, but all donations that come in prior to June 30 of a calendar year have to be used for the following school year. So every gift that came in before June 30 of 2020 had to be used for this 2020-2021 school year. However, any gift that comes in from July 1 of 2020 to June 30 of 2021, we can push and move around. And so what we've done is worked with donors over the years to try and, if it's in their ability to do, we've tried to manage those so that we're not pushing too far on one time and losing donations to the diocese. But Tom is correct. At this moment, the number of students we have not fulfilled their full need at this time.
Thanks,
What
Mike.
limit, under what circumstances would you not be able to continue to take the credits or the donations from us?
No, great question, Mike. So what happens is you have to have students who qualify to receive the donation. And so it goes through McMahon Parader, and that's who certifies that they are viable. They're checking on who I and Frank have turned in to say qualify. So to prove that they do indeed qualify. And then once we know, and so the way a student qualifies is that if they qualify, what they're entitled to is a number of a dollar amount that the local county public school that they would go to would receive in funds from the state. And so, for example, Albemarle County says it cost about $13,000, maybe closer to 14 at this point, 14,000, let's call it, dollars to cost to educate a child. They ask for about $3,800 per student from the state. So a student in Albemarle County can only receive that $3,800 of tax credit money. Our students from Fluvanna, Greene, some of the other surrounding counties, it's closer to $6,000 that those counties are asking for. And so those students can qualify to that point. If the donations have come, and this is how we run out, Mike, if the donations have come in at a higher amount than those selected county dollar amounts, then we're not allowed to use them. And if they came in prior to that June 30, we would give those back to the diocese, who would then give that money to another Catholic school child within the diocese. And so even in the end there, while I would say so far 100% of those donations have stayed Charlottesville for Charlottesville, if we happen to go over it, you still are affecting the lives of a Catholic school child somewhere within our diocese. But again, we haven't gotten to that point yet.
Okay, any other comments, questions at this point? I'll move on to some other tricks here. This is one that I found to be very, very interesting, and yeah, I don't think you'll probably find this one written up anywhere, but let's assume that you use these tax credits to fully offset your Virginia income tax liability. Well, that means next year, when you have, so when in let's say 2021, you've completely offset this year's tax liability. So next year, when it comes time to file your 2020 Virginia tax return, you don't pay any Virginia taxes. Well, then in 2022, when you look back to the 2021 tax year, you pay no Virginia income tax. So assuming you're itemizing deductions, you have no income tax to take, but you can take an itemized deduction for the Virginia sales tax that you paid. And the IRS has a table, depending upon tax rates, that anyway, make a long story short, you can save another couple of $100 in future years to the extent that you've totally eliminated your Virginia tax liability in those years, in the preceding years. So I found that to be just a nice little benefit that is there in addition. Any questions about how that works? And again, and also, of course, you must subtract if you were deducting state income tax on your federal return, that is not deductible on your Virginia state return. However, Virginia sales tax is deductible both on the federal and the state return. So you get an additional little benefit from the Virginia sales tax deduction. But again, assumes you make a contribution large enough to to wipe out your Virginia tax liability. Was there a question, comment? Okay, all right. Well then, and again, there's just one other thing that you may want to think about in terms of making larger contributions. To the extent that you can reduce your federal taxable income below a certain threshold, whatever remaining long-term capital gains and qualified dividends you receive may be taxed at a lower rate, or in most cases, and here's the number: if you can get your taxable income on a joint federal return, if you can get your taxable income under $80,000, there is no tax on qualified dividends and long-term capital gains. So that happened to me a couple of years ago, and I thought, but I use tax preparation software. I thought, oh, there's a terrible bug in the program. And then I finally realized that because a certain part of our income was from long-term capital gains and capital gain distributions and qualified dividends, because our taxable income was under $80,000, none of that was taxable. So it was just amazing. So that's another little benefit. Now, I just want to move on. I've got a couple notes here, make sure I covered all of that. I think I did. The couple of unique opportunities this year, and they're only this year, and I can't foresee them going into next year or being reenacted. The CARES Act, the COVID Relief Act. One thing is, even if people don't itemize deductions, they're still going to be able to take a $300 charitable contribution deduction anyway on their federal taxes. That's not going to affect people who are looking at making large gifts for tax credits. So I'm not sure. It's just, I just say it, so I've said it because that's one of the tax benefits. But the one that I think are going to want to look to for those who want to, let's say they've got a substantial number of assets, and they would like to make a very large gift to, well, the McMahon Prater Scholarship Foundation with benefit for Charlottesville Catholic School. The one-time cash, and this applies to cash contributions only, cash, check, credit card, not to appreciated securities. But assuming that someone is in a position to do that, in the past few years, some years ago, it was limited. Cash contributions were, the deductibility of cash contributions was limited to 50% of your adjusted gross income. Now, then a few years ago, it changed to 60%. For this year only, because of the CARES Act, 100% of your adjusted gross income is deductible to the charitable contributions are deductible to the extent of your entire adjusted gross income. So you can basically wipe out your federal tax liability. Now, once again, whether that's a good idea from your personal standpoint, from your tax standpoint, from your tax strategies looking out into future years, I don't know. That's between you and your tax advisor, but it's something to be aware of. And today being December 10th, there's not a whole lot of time to think about proceeding with that sort of strategy. So anyway, and so that's what I know about it. I think Colleen will probably want to take us through how, the logistics of this. How do you actually do this? So I'll turn it over to Colleen, and I'll be here to answer any questions. Unless someone has some now, we'll turn it over to Colleen. You're mute, Colleen.
I'm always got something a little wrong. But I will say that from everybody that I have talked to, one of the first things that we encourage them to do is to talk to their financial advisor about this. It never fails. They come back and say, yeah, I'm going to do it. because they've gotten that advice. So I do want to say that that's a very important step to take, and it will probably make a very big difference if you do that. The other thing is that the forms that you've been given already are really all there is to it. There really couldn't be anything simpler than filling out the one is the letter of intent form. And Mike, correct me if I'm wrong. Because we're a regional school, there really isn't any direct competition right now unless we meet a certain quota that money would go somewhere else. Am I correct?
In Charlottesville at this time, we are currently the only school collecting money for this program. There are a collective of other Christian schools that are joining a group where they may see some benefit. Those dollars wouldn't get mixed with McMahon Parader. So we are the only Catholic Diocese of Richmond entity in Charlottesville accepting donations.
And the other thing is, the other key piece is to fill out the pre-authorization form. And these are like fillable forms. You have them electronically. You can fill them out and just save them and shoot them off to the McMahon Parader. They will get back to you within 24 hours and, let you know that you have reserved these tax credits. The form lasts for 180 days. So, but if you want to take advantage of the 2020 year, you'll need to get this information to them, I believe, by the 21st.
Could I just jump in, Colleen, and say,
Yes,
you
please.
can do this all electronically? I mean, there's nothing goes in the mail anymore. My son just made a contribution to McMahon Parader, and he was amazed that within 48 hours, it was all done. He had everything he needed, other than ultimately the Virginia Department of Education will send through the normal mail channels the actual certificate for the tax credits.
Right. But literally, that's all there is to it. And it's since I've only been here for about 18 months, and it's gotten so much simpler even just since I arrived. So they make it very simple, and they're very responsive. So, and if you have any questions that are, questions that we can't answer, you can send them an email and they will turn that answer around back to you very, very quickly. So we just feel very supported in this.
Hey, Mike. Sorry, go ahead. I was just going to ask Mike, what is our cap? At what point are you allowed to share the dollar amount?
I can. It's ever changing target. So as students qualify, so many things can happen, right? And so let's say the Webbers qualified. Tom, you're just in front of my screen. You get picked. Let's say the Webbers had qualified and they were receiving these, but then Dr. Weber there got promoted, and his income had moved the family out of the bracket, or his wife got hired by the greatest institution with the best boss. Then, and that happened. So that is a way that the cap moves. You have to qualify, and to be able to qualify, you have to be an incoming kindergartner or first grader, or come from out of state, or have spent the prior year in public school before coming to the private school.
Gotcha.
Plus there's the income qualification that the family has to meet. And so, for example, COVID has a few of our tax credit families decided to homeschool instead of be part of the school. They have actually lost their ability to receive those tax credits if they decide to come back to us next year when school is a little more back to normal, because they've been in a homeschool situation and not those other qualifiers. So that it's hit or miss. I will say 2 years ago, and I just cleaned my wall. It was up on my dry erase wall. I just wiped it off yesterday. 2 years ago, our cap was $189,000 worth of tax credits we could take. I think this year we're sitting around 167,000 that we could take. I know that we have given out just south of 140. So there's still about a $25,000 that could have been given this school year that we did not. So we did exhaust all the donations that were given before June 30th, 2020. Did tap into a little of the donations that have been given prior, but want to kind of hold those back to start next school year, depending on how donations come in between now and June 30. Yeah.
So you'll manage it to make sure that our donation goes to, if I'm CCS centric and,
Yes.
All right, got it. I don't have to worry about it being managed to that.
Yeah, and so Mike, let's say you were trying to think about doing this for this year's, your tax situation for this year. There is a very quick turnaround time. I for now, if you could hold your donation and say you wanted to try this and do it after the school year, I will have a better sense of who our new students are. So re-enrollment time doesn't align up with fiscal giving on federal deductions on that December 31st date. I understand that, but I will have a much better sense come mid-February on what next year's tax credit need will look like, depending on who we accept and then who stays in the program that is currently here. We have had those wonderful situations where families have, found their life circumstance take a turn for the better and they no longer qualify. And of course, we want to applaud that, but then that money is no longer part of our budget. We are looking at, though, in the school, that it's north of 100,000 over the last 3-4 years that we have taken. That's money that is operational, that if we didn't get through the tax credits would be an unfunded discount to allow those students to be here. So we'd be operating by that less funds.
Got it.
Colleen, my question was, you had mentioned the 21st was kind of the deadline to do this. Is that earlier if we do this with appreciated stock? Does it take any longer to do the logistics of it?
I think it's just a matter of filling out the form. And I will get that question answered for you this afternoon. I'll check in with them directly, but I don't think it's going to have a big impact. Because I know you will have a turnaround on that, but it won't be long. And I think it's just so that everything is done by the 31st. But the 21st is like the day the process has to start by.
All right. Thank you.
Which form is it? The letter of intent or the pre-authorization form you're talking about?
It's the pre-authorization form is probably the most critical. Am I correct there, Mike?
I believe so. Both need to be filled out and turned into McMahon-Prater, and then it is a quick turnaround. They're constantly monitoring their emails to work with that. I just know that date of the 21st is that's more of a Virginia Department of Education cut date on the people who are processing the tax credits, where they're saying anything after that we can't guarantee we get processed before December 31st.
It's the holiday.
Be processed by both McMahon-Prater and the Department of Education for it to count for the current fiscal year, if I know what I'm talking about.
You're saying it may not have to do with our own personal taxes. Like that may not be a cutoff for our own tax filing.
Right. The credit they may not be able to issue the credit before then, and then therefore you may not be able to use it for the 2020 tax liabilities that you may have. Tom, is that sounding accurate?
Yeah, I think so. Although, you know what, I really recommend you talk to the people at the staff at the McMahon-Prater. They can give you some very clear answers to that. And I don't really know. I know that, I know they can handle the fairly quick processing of appreciated securities. I mean, they're geared for that.
Mm-hmm.
Whether, where that 21st date comes from, if that really is a Department of Education date and they say, we can't get you the credits before the end of the tax year, well, then that becomes a, greater urgency. But
that is my understanding.
Yeah, well, that could very well be right. So, but I think we probably owe everybody an affirmative answer to that. And Colleen can just email that out as soon as she talks.
Yeah, I will. I'll find out. And and Joyce just sent us an email last night, and that's where all of this is coming so fresh in our minds.
Right.
But Mike, you've got a gap for 2021. So if we can do it before the 21st, it would be applied to the gap you've got for 2021. I think you said it was like a $20,000.
Yeah, and so yes, you have until June 30 for that gap.
Okay, got it.
The 21st is for your personal tax filing for the 2020 school, for your 2020 taxes. Yeah. As far as CCS is concerned, for next school year, we have till June 30 for those donations to come in. And so that is where, Mike, where you're asking how I would manage it. If you are thinking about doing this and you're thinking about, well, I want to know to be sure, and you're not worried about your personal taxes for 2020, I would say that we'll talk with Joyce, but there's a time and place where I know the students and I can say, you know what, Mike, we are so close to filling 2021. If you could give your donation after July 1st of 2021, then it can be applied to the 2022 school year where we know we'll have a gap because I know the Smiths are no longer going to give after this year kind of idea.
I gotcha.